Capital, Ozan, very good to see you this morning. Very hard to be too optimistic in the wake of what Dan's just been telling us. Why on earth the US markets at all-time highs?
Good morning, Ian. And look, I think markets are just overly optimistic because traders are seeing what they want to see. It's plain and simple, right? I mean, if you have a bit of good news coming out from True Social or Twitter or X, whatever, on the weekend, you know, we kind of trade up as if it has never happened. If you see a bit of a problem, then everything is down. The truth is somewhere in between. But again, the human emotion, the instinct of traders to want to go back into a more quote-unquote normal world persists, but we are not going to get there.
Yeah, we'd all love that. I mean, it feels as though we have structurally higher inflation now for some time. Looking at what's happened to the oil price, what's going to happen to oil products, the fact that the straits are going to be closed, this is huge backlog. Inflation's going to be higher for quite a while.
It is, and I think we were getting there before anyway, because I think we had acknowledged the fact that inflation is not just temporary, it's sticky, and I dare say even potentially structural. And that was before the war really kicked on. And look, let's just face it, it's going to take us 3 to 6 months to see the impact of this anyway, even if the war stops today, right? I mean, the whole supply chains, inflation coming from it. So when watching markets, when I'm watching data points, I try to look at PPI numbers more than CPI numbers as well, because that's where the problem is going to illustrate itself, right? Is it going to erode into the producers' margins? Potentially. Will they pass it on to consumers? Maybe. But inflation is here to stay.
I notice even in China, we've had a slight creeping up in factory gate inflation over the last period.
That's right, we have. China has been playing its cards quite carefully, and I dare say strategically. One thing to watch out for, though, because look, last week we witnessed the Q1 results of financials in the US. Great results, almost a remnant of an era bygone by now. A lot of that was driven by sovereign wealth fund capital coming into the US. I think the numbers were somewhere around $140 billion or so invested in the US markets in deal making from sovereign wealth funds last year, which was, I believe, over 50% of all the flow that came into the States. Now, will that stop? I don't think so, and obviously not all sovereign wealth funds are Gulf sovereign wealth funds, but a majority of capital has come from the Gulf. Now, thematically, that need to diversify out of the hydrocarbon economy and invest in innovation is going to continue. In the short term, we just don't know yet what percentage of the allocation will have to be spent at home, propping up defenses, propping up the markets, and that may have an impact on markets as well throughout Q2 this year.
Ozan, there's a brilliant write-up in the FT by Tej Parekh about the decoupling of equity markets in the US from, I suppose, some of the realities on the ground. He's saying it, the new approach to valuation. And there's one graph that jumps out at me in particular, and it's the line showing US job openings going down, and the other line showing the S&P 500 climbing. Now, if the job openings are going down, and if those who are even in a job are paying $2 a gallon more for diesel than they were a year ago, almost $1 more for a gallon of gas, at some point, the reality is going to come and crash up against the optimism in the markets, because it's the consumers who will be funding those future earnings, isn't it?
That's right, 100%. And we don't know when that point is going to come. By the way, that's a bigger question and a bigger conversation about what will happen to society at large, what will happen to economies that are based on society performing and functioning effectively. And that conversation is going to have to happen continuously as AI, if not replaces jobs, replaces those resources that cannot utilize AI. So as firms become more efficient, and obviously they are driving bottom line, and because all public listed firms are going from quarter to quarter, earning to earnings, and because investors, all of us really, are driven not by long-term cycles, very, very much driven by short-term compensation cycles. So we see what we want to see until a point at which we're going to have to see what the reality is. Now, we don't know what that point is, but that's a great statistic to watch out for. I mean, who will spend? What will the earning and spending power of consumers mean in terms of real industries? Now, given that liquidity is concentrated at the hands of the few with bigger balance sheets that are trading the markets, that's why in trying to understand what the reality looks like, I think we'd be well advised to watch out for the cyclical movements and the demographic and social shifts that will impact the real economy.
In which case, if the markets are behaving like we've passed peak escalation of the conflict, maybe we have, maybe we haven't, but it looks like the markets are looking towards the end, beyond the end of the conflict. If they are pricing on that basis, but we haven't yet had peak impact economically and financially, how are you positioning to insulate against the worst of the losses if there is a correction? And where are the havens? Where are the safe havens? Because again, looking at bond yields, there's another bond sell-off. Yields for all government debt is up.
The concept of the notion of having a safe haven is a fallacy. In a market like this, I think your safe haven is your capacity to dynamically adjust your portfolio, and therefore the quality of your teams in being able to trade this volatility. Now, I can tell you, and I do believe this, that there's a premium on cash and liquidity. So therefore, money market funds yielding more than they have done is not a bad place to park a part of your liquidity. At the other end, you really want to be betting on inflation because that's where the future growth is going to come from. And whether that's robotics, AI, biotechnology, propulsion tech, energy infrastructure, defense tech, you name it. You're going to be betting on inflation, in innovation. Now, in that place, you really have a choice of investing either in the US or in China, and anything in the middle really is quite challenging. Now, when it comes to bonds, especially longer dated bonds, and we had been in the market ever since May last year, when Japan went out to the market with a 20-year and a 40-year and really couldn't get the pricing that they wanted. Ever since then, we have, if you will, had this paradigm shift in the mentality of investors thinking for long-term bonds, i.e. anything defined over 10 years, what are we really trying to price? Are we trying to price geopolitical stability, innovation, technology, social changes? So I want more for my risk. And there's roughly about $145 trillion or so of available kind of paper out there, 40% or so of which is over 10 years. So we're talking about a repricing upwards of roughly $55 trillion of debt stock anyway, which is going to mean elevated cost of debt, elevated cost of capital, and we're going to see that play out. So if you are trying to find your safe haven, maybe a bit of liquidity that gives you a little bit of yield combined with innovation, and anything in the middle is going to suffer. One quick note there, I think in the whole EM play, investors chasing for yield, in a market like this with a commodities crisis, I dare say like this, I think there's a big difference between those EM countries that are exporting inflation versus importing inflation. So it's not a bad idea to bet on those that are exporting inflation at this stage.
Yeah, and to that point about the energy price shock, the Strait of Hormuz was barely open. You could probably count the number of hours on the fingers of one hand on Friday before it was shut again. Oil and gas is not flowing as normal yet. There's no clarity about when that will happen. The ceasefire between the US and Iran is due to end on Wednesday. The ceasefire between Israel and Lebanon due to end on Saturday, Sunday next weekend. In which case, do you think the central banks can continue to sit on the sidelines and adopt a wait-and-see approach? Or is it going to become increasingly apparent that regardless of when all of this comes to an end, there will be inflation baked in and it will hit at some point?
I think inflation being baked into this crisis is a given. And therefore it's going to restrain the capacity to act by central banks. And again, at least my base case assumption is that central banks across the world in DM space in particular will have to adapt their strategies, assuming that they're going to be fighting inflation for a lot longer.
Got to leave it there. Good to see you this morning.
Likewise.
Oscar, co-founder and chief executive managing partner of Tanto Capital. Thanks for joining us today.